Nothing said on the Touchgrass podcast is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions only, not financial advice or necessarily the views of the Touchgrass podcast. Our hosts, guests, and the Touchgrass podcast team may hold positions in the companies, funds, or projects discussed. Enjoy the show.
GM everyone, welcome back to another episode of Touchgrass Podcast. Ayyan is back. We are in for the second time on the show. We kind of promised Ayyan we should bring him on once OnRe hits 200 million in assets under management, and they've finally done it. Super happy to see this kind of journey along since kind of the early days. But yeah, finally we're back. Welcome to the show, Ayyan. How are you?
Thanks for having me, KG. Really excited to be here. And it's actually funny. I think the initial deal I had with Rashid was that we would have to double up our AUM or hit like 100 million or something like that. I forget what it was exactly, but I think like within a month or so we hit that target, and then now we've been able to grow rapidly. There's a lot of acceptance towards OnRe across the ecosystem, and here we are just above 200 million in AUM.
100%. As you all know, like on we've talked about yield that's not correlated with crypto in the show, where yield that's more sustainable, yield that's you can actually see the track record and see how transparent it is, and the demand for that just keeps growing. But yeah, and like to kind of help set the context for our new listeners, what is Andre and what is reinsurance markets in general?
Yeah, it's a quick question to start with. Reinsurance is insurance for insurance companies, but the simplest form, especially if you're thinking from a financial services, capital markets perspective, it's a risk transfer product where you have a lot of insurance companies are underwriting various types of risk. We primarily focus on property catastrophe reinsurance, as well as doing some specialty as part of that. But the overall view here is that you have an insurance company that might be underwriting large properties, large values within certain regions. Let's say, for example, Florida with hurricanes. And as part of that, they want to transfer a portion of that coverage of the risk to what we call reinsurers, which we have the capital to be able to allocate and help underwrite those risks. As part of taking on that risk transfer, we get paid out what's called premiums, which is the yield that you see accruing to the ONYC token as that premium is being released and recognized by OnRe in a form of NAV being adjusted on daily basis is the way that we have it working currently.
Yeah, let's try to unpack that, right? You always see stuff on Twitter like junior tranche, senior tranche, the risk is adjusted. Like, I mean, I think everyone heard the word tranche in the Big Short movie or something. But yeah, try to kind of unpack what that actually means, how risk is kind of hedged, or yeah, how that thing works.
Yeah, so I guess there's two ways to look at it, right? Like as a licensed regulated reinsurance business, the typical way that reinsurers are oftentimes let's go about approaching risk from their own perspective is that they're reserving. So of the premium that we're generating for underwriting a lot of these various property cat deals, we take a certain amount of the premiums per deal and we reserve that. The reserving there is done so that way during your risk seasons or periods of high volatility, you can actually utilize your own reserves to be able to help cover losses that may come on the book in the form of claims, right? So this ensures that your users are being protected from potential upright full-on risk transfer losses. Instead, you're utilizing those reserves to help cover initial claims. Now, beyond that, this is where the interesting thing comes in. So that's what we do as a licensed business, as a traditional business. That's more of an actuarial math process versus when you're talking about DeFi, right? You talk about senior tranche and junior tranche. Now, inherently, OnRe could launch their own tokens and create their own junior and senior offerings. I believe that it's best to simply focus on one product and then allow for DeFi in a permissionless sense to introduce the very products and offerings that they want to see, which I think has been very popular recently. We've been privileged to be able to work with the Exponent Finance team to allow for the first credit tranche, if you will, all across Solana. So now you're having users who want to essentially maybe diversify or reduce the risk to OnYC, so they want to mint OnYC tokens. Or you have other users that don't want to take on additional, let's say, smart contract risk via looping and all these other constraints that come in from supply rates, etc. They want to go and take on the junior rate because they view the yield opportunity as being a good risk reward ratio. So for me, that's the beauty of being able to combine real world premiums, real cash flows, and then allowing DeFi to productize those offerings.
Yeah. So if I have, let's say, $1,000, I go to OnRe and I deposit my stables, I buy on YC. How does from there? What do you guys do? How do you deploy that money?
Yeah, so for us, for every dollar that comes in, we target to be able to deploy about 80 to 85 cents of that into real world insurance products. And then we keep about 15 to 20 cents on chain in the form of, let's say, tokenized stable coins like USDG. And that's to help facilitate liquidity all across the ecosystem. So we have active treasury management that's supporting what we call like a liquidity buffer. So that way users like yourself are able to freely trade across secondary markets. And then we are providing liquidity to the market makers to be able to sustain price on secondaries. Or if you're a KYC user, you can come to our main platform, be able to redeem, pay a redemption fee, plus be able to access a certain percentage of liquidity on a monthly basis. So that's the way that it works for general users. And then what we're doing actually with the 80 to 85 cents is we take the USDC, we convert it into tokenized T-bills, which are banked with the Bank of New York Mellon. And then they are set up in very traditional trustee accounts, which a trustee account is basically saying OnRe plus a cedent who we are underwriting the risk for or doing the risk transfer with. They are putting in the premiums, we're putting in the collateral, and then over time, over the duration of the event, they'll release some of that, let's say, the premium coverage to us. And then if there are claims, then we release our capital to them. But it's all structured within a trust account in Bank of New York Mellon.
So that 85%, I'm assuming that's entirely off-chain? Or is that something where people can see where that money is going? Or I believe it's off-chain, right?
Yeah, it's off-chain, but we still have attestations that are produced, and we provide them into our transparency dashboard. So actually, if you go into like our docs pages, you'll see all of our statements that show you. Plus, we have attestations being provided by Apex, which is the same group that does the attestations for Coinbase and other large financial institutions in the space. So our goal, though, in the future is through various ZK integrations, etc. We're currently working with Accountable to be able to allow for real-time verifications of the capital being allocated. So we won't probably specify like who the counterparties are, the types of direct risk transfers that we're doing, but you will be able to verify that there wasn't that, in fact, a deal that was confirmed, and you'll be able to verify whether or not that capital has been properly allocated and transferred.
Yeah. And like, how do these deals, like, okay, you got the money, and how long does it take to get into these deals? And how long do they last in general?
So you're referring to like our reinsurance deals that we're currently underwriting?
Yeah.
So it's actually unique, right? So for OnRe, we primarily focus on property cat. And the reason that we focus on property cat is because we believe that this is the most aligned with on-chain capital and with DeFi in the sense that it's short tail business. So the maximum duration of these contracts are 12 months, and they can typically last anywhere between 3, 6, 9 to 12 months. What's interesting about that is that all of the deals that we're underwriting align with the major deployment dates for property reinsurance or reinsurance in general, which January 1st is the most busiest date. That's your renewals period. So 90% or so of the deals that are being underwritten for the year are underwritten then. Then you have other dates like February, April 1st, June 1st, and July 1st, where then there's a lot of risk transfer products or net new deals are being originated during that time period. But for us, we feel very confident writing these types of deals because the claims themselves also are being resolved within the duration or a few months later of the contracts that we're underwriting, right? So whereas if you're trying to underwrite casualty business, these are very long tail events like life insurance, etc., that could have a, let's say, claim being paid out 20 years later. So if you're currently underwriting a risk transfer on a product like that, you could be assuming that, hey, this is a very low vol product, but a claim from 20 years ago come out of nowhere and it hits you, and that forces you to
Yeah.
look at some of your assets. Where in our case, we're able to model based off of the best historical data that's available and to know that if there was a claim to occur, the 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 capital would be paid out within the duration of that contract, and then we would be able to unwind that deal at the end of the duration. So for us, it's a lot safer if you view it from the perspective of liquidity, to be able to write this and bring to DeFi.
Yeah, and usually I mean I don't have probably the full knowledge of this, but in general, some of these contracts and how much the premium is paid, does it depend on when you enter these deals? Like the time frame, does that time frame is the same, but the timing of that, does that matter? Where the premiums for each thing would differ, or is it the same thing for every contract?
It definitely isn't the same for each contract. So there are multiple different things that you're looking at when you're underwriting a property cat deal. So one is always the peril, right? Not all perils are the same, and we typically underwrite major perils. So we're talking earthquakes, hurricanes, windstorms, things of that nature. Then from there you have location or geography, because as we know that not all geographies have the same, let's say, insurable like value. Underwriting a hurricane deal in Florida is very different than underwriting a hurricane deal in like Jamaica, right? So for that perspective, like there are reasons that certain premium rates are higher. And then on top of that, within a certain deal, there are multiple layers or attachment points. So attachment points is oftentimes where you would be triggered for claims to start being paid out. But then there are layers within that. So let's say, for example, if you take a lower layer, you might have a higher premium rate. But if you take
Yeah.
a higher layer, you might get lower premium rates, right? So vice versa. There's a sort of math that we do in towards understanding how we model the book, and that's taking into account all those factors that I just mentioned to you.
Awesome. And does that the scope of OnRe in future, is there like expanding to things you're insuring, or is it just property for now?
Yeah, I think the expansion is going to happen sooner than later. So that's something that we are excited to explore. I think that the world of reinsurance is $1 trillion business, and it would be wrong for us to simply focus on underwriting one type of product. We think that our, let's say, focus and strength, especially from the underwriting side, is currently on the property catastrophe. So we are underwriting that, but you could expect us to launch various products in the future where you could get opportunities that are maybe more, let's say, low volatility. Maybe we can create higher volatility products for those users who want to have as much yield exposure as possible. But of course, with the various types of introductions to the market that we would make on those types of products, you have to think about your own yield profile, your own risk tolerance, your own capability to withstand losses on the book, right? So we are exploring a bunch of different ideas, and I'm very excited about some of the things we have planned before the end of the year.
It reminds me of that scene in Big Shot where they say, "What's the market size of the insurance that insures the insurers?" Where it's 20 times bigger or something. So that's definitely a big opportunity.
Absolutely. I mean, like, especially right now with anyone that's like, looking around the world, there's constantly new types of events that are occurring.
Yeah.
If someone's talking about this, like we're seeing how does the world of AI growing impact reinsurance? You're going to have now a whole bunch of new data centers that are popping up all across the world. They're going to have to be insured. So there's going to be unique types of policies that we're being able to underwrite while, tech and the infrastructure, especially in DeFi, improves that constraints the types of yield people can make on carry trades, etc. And for us, as tech improves and there's more unique opportunities out there, the ability to underwrite only increases.
100%. But yeah, why don't we talk about the increase in the AUM for OnRe? We hit 200 million recently. Can you talk about like this? Because everyone says DeFi is dead and that it happens, but you were in a unique position on Solana where a big hack happened with Drift. Everyone kind of lost hope in DeFi on a couple of months back in April, and everyone thought it's going to take some time back, but still believed that Solana is a good place for DeFi. But can you talk about this journey of reaching 200 million? Anything that you look back and saw that was an inflection point in your opinion?
Yeah, I mean, thinking about the fact that it's been over a year now, getting to 200 million, it's been a very scrappy process. And I think one that also shows the maturity of the industry. I think people are looking towards more uncorrelated yield streams. That doesn't necessarily mean that it's a guaranteed yield stream. It just means that you're actually having real cash flows that are backing these instruments. And that I think is a signal for an inflection point that was derived from OnRe's innovation to the market, right? So considering the fact that we are a licensed, regulated uh, reinsurer based out of Bermuda, we are now working on ways to be able to ensure that that real premium is being accessible on chain. So our NAV is being constantly published. It's being verified by various oracles like Chainlink or Pith. We are supporting unique integrations to allow for greater capital usage. So unlocking capital. So on one side, the fact that there is liquidity to OnRe's book of business because we keep 15% of the book unallocated. You have liquidity in the secondary markets. Plus, what I think is really important is the actual utilization of OnYC as productive collateral all across DeFi. And that's really where the permissionless channel to unlock net new capital inflows really comes alive. You're seeing people deposit OnYC in DeFi as a form of collateral and then potentially looping it. You have people who are depositing OnYC, using as collateral to maybe go and use some of those amazing assets that are on Sunrise DeFi, right, to get exposure to some tokenized stocks and RWAs. And then you also have people who are looking towards the credit world, right? And so they're either yield trading or tranching their OnYC tokens on Exponent Finance. So I think that is really the inflection point of where we're able to combine the processes that we have been accustomed to in the regulated world with the transparency and efficiencies that DeFi as a market expects. I don't think we have perfected it by any means, but I think that we are a leader in that space. I think we are taking the right steps to constantly improve it. And I'm very excited about some of the initiatives we have coming forward that will also allow users to do the same level of due diligence that we do. So I can't speak on that just yet, but there should be an exciting opportunity soon.
100%. I think the change in how people are investing and how people are allocating capital is slowly kind of shifting. I mean, memes are always memes. There'll always be a thing in space, especially on Solana, but definitely agree on that kind of shift happening in DeFi. But I want to ask you one thing, Ayyan, like, with Solana is like in a unique place, and especially for you guys, I have a question, but they're doing a bunch, they're everywhere, they're doing a bunch of things when DeFi is growing. But in your case, as you said, most of what you do, how you allocate that capital is off chain, where on chain people have these redeemables, they can loop and stuff. But that's not like you're heavily dependent on Solana, the blockchain. So what's like the underrated part about it? And does the same thing, like you're not kind of taking this advantage of being Solana, the performance chain in general, but does that like kind of comparison make sense where because you're doing most of your stuff off chain, how is your like advantage of being on Solana?
Yeah, so I think that in general, being on chain provides us the advantage of liquidity and utility on chain because you have to think about the fact that in traditional reinsurance, the timeline for major pension funds or private equity firms that are backing reinsurers is 10 years. Now, all of a sudden, you have an asset that you can hold that you could potentially sell instantly to be able to liquidate your vested interest in those in the performance of that reinsurer. You can also be able to take that and put it to work on DeFi. I do believe that Solana's infrastructure is the reason why looping is as popular as it is, because I think these types of strategies in terms of automating it on the EVM is a lot more difficult. I think that process is more manual there. It doesn't mean that it can't happen and that it's inherently better. I just think that's why we're seeing the attention of products like Camino, Multiply, Loop Scales, Looping Vaults, other sorts of vault managers now looking to get into automating these types of strategies being very prevalent on Solana, right? And we also see the growth of Jupiter Land and its order book system that they've been working on. So inherently, I think that's the major unlock of Solana is that there are certain use cases in DeFi that are not possible elsewhere. And beyond that, I think for us, as from the traditional sense, we are now seen as a major capital partner and not just a direct underwriter for Bermuda or for global reinsurance. And what I mean by that is because of the accessibility, because of the utility of OnYC as a capital asset, as a productive collateral all across DeFi, we are seeing more capital being available to us to deploy. Right. So now all of a sudden, right now, the team today is like July 1st. 7/1 is a major reinsurance deployment date. It's like the third or fourth largest. And we have so many people and teams, brokers, insurance companies, etc., that want to work with us because they see that we have this level of capital available to help underwrite some of these risk transfer products. But then that's where the art of underwriting comes in, right? You have to learn to say no because you want to make sure that you're focusing on deals that only fit within your scope.
So is that like where you're at right now, where the capital is in excess and deploying is a problem?
Yeah, I mean, I think that's exactly where we're at. But that's why we do this sort of, forward-looking yield calculations to be able to understand with our growth where things are going and how we can make sure that we can ensure that users are not seeing massive capital drag on their deployments. And as we grow, the capital drag continues to be lower per dollar in the sense that if we're actively underwriting, the dollar drag is minimized because of the fact that we've underwritten that much more deals, right? So our target, like I said to you, is between 80 to 85% of AUM being deployed. I think right now we have about 140 million allocated. So about 100 or so, 110 or so is currently on risk, with another 20 to 30 million is being allocated. Some of them have been incepted, some of them haven't been. Just check the transparency dashboard to get the most recent information. But I think our goal is by after this underwriting period for us to be at roughly 80 to 85% deployments.
Got it. And the current yield is around 10%, correct?
Current yield is just under 12%, actually.
And the target is 12?
Yeah, so the target yield is 12%. What we will start to introduce and what we're planning on doing is being able to introduce some level of a buffer. So that way, if we are generating real yield above that 12%, we would take the excess yield and be able to create a first loss buffer with that. And I think a lot of investors have been excited by this idea. And I think this is actually one of the first places that we're mentioning publicly. So some alpha for your users. We believe that this is an important step to make OnYC more of an institutional asset that everyone wants to hold, irregardless of their risk tolerance. And so with the first loss buffer, we're really excited to be able to see what we can do across the DeFi markets and how that impacts our user persona.
Yeah. Can on NYC be used as collateral on any platform? What's like the requirement there? Let's say you want to partner up with someone where using collateral from one place, one other. Like, what's that? Like, how do you partner? Because I feel like in my mind the possibilities are many, but I'm betting that the risk tolerance or risk appetite for each thing is very different. So how do you measure those partnerships or whom to partner? Because if these things kind of open up, we just the amount of capital that will be available to kind of allocate will be more. So how do you kind of decide which opportunities to pursue in kind of just attracting more deposits?
Yeah, I think it actually goes back to something that you mentioned earlier, right? It's like this is the power of permissionless DeFi architecture. So while our token requires people to be KYC to be able to mint or redeem and meet certain requirements, that token is also completely transferable all across the DeFi markets. Inherently, it also means that people can create the products and experiences that they want to see for OnYC. So that's just one, that's a caveat. But two, I think the thing that has been really powerful in terms of the way that we approach our partnerships and where we want to promote certain strategies with our partners is thinking about what is it that the investor wants. So borrow lend protocols, I think, are the most clear use case for an asset like OnYC. It's a yield-bearing RWA. Typically, if you go and look throughout the history of DeFi, most people are depositing their stable coins, borrowing against it to go and purchase Solana or any other highly volatile asset. In this case, my view is, okay, do the same exact thing, but why not utilize OnYC as your collateral? Now you know that you're gaining, let's say 10 to 12% off of the underlying asset, while at the same time being able to borrow stable coins either to reinvest into the OnRe ecosystem or to be able to go and buy Solana, buy Hyperliquid, buy some of these new tokenized RWA stocks that are existing on chain today, right? So I think that's really how we approach things, is understanding, one, the benefit to OnRe's ecosystem in terms of our main KPI, which is AUM. Two, creating better products and experiences for our users, so that way there's greater utility to their capital. And then three, creating more secure offerings, right? I think credit tranching is a great example of that. It allows for users to really understand, what is my risk profile? What is my tolerance? And then from there, I can either assert towards running a senior strategy or a junior strategy. And then from there, a lot of the senior users feel more comfortable utilizing that as a collateral asset because they can go and loop at much higher confidence.
Yeah, I think with more stock coming on chain, the optionality becomes bigger, and I think more people will opt into this. But yeah, and I think we're close to time. I have a couple more questions for you. Uh, One thing is, I mean, Fable 5 is back, so everyone is freaking out again for crypto hacks. But what are your thoughts about, April was crazy. We saw a hack almost every day, and everyone's kind of bearish DeFi in that sense that someone can just prompt hack stuff, whereas everything is pretty much dependent and social engineering is a thing. But what's your like high level thoughts on AI and hacking DeFi protocols, and any advice for teams to kind of safeguard themselves? Because I know that even though you do a lot of stuff off chain, you have these things in place. But any thoughts on that?
Yeah. So one, I think like a lot of people always say DeFi is dead. I think if you look at OnRe's data, since the drift hack, we've actually grown 50% since that period, whether it's across like cumulative TVL on DeFi. So I think that's really interesting to look at, just comparing us to other markets on Camino. Now, for more generalized advice, I think that what you find with a lot of these hacks is that it's not a direct smart contract exploitation, it's a human brain exploitation. A lot of people are making silly mistakes, especially when you're considering the fact that you are managing over hundreds of millions of dollars. So I think that for us, we try very hard to work with the right security partners. We try to engage with audit firms in a way that it's more of a partnership and not just a check mark. Solana Foundation also started a new program where they want people to go through security audits and reviews. So I think taking advantage of all these resources that are available in the market is the best thing that any founder or any DeFi builder could do. And then more importantly, I think it is a requirement for every team, technical team, operation team, to consider their procedures when it comes to managing their smart contracts. Understanding if they have any fail safes put into place, making sure that their multi-sigs meet the required like threshold for if someone were to do some social engineering, you still want to make sure that their threshold of multiple people signing a multi-sig is the standard, right? Not just 2 out of 3, or let's say significantly below 50%. That's just asking for trouble. So I believe that overall DeFi teams are becoming more smart. And yes, you can use AI to maybe find more exploitations. I think you can also use AI to be able to better understand your own code, do reviews, and be able to like build out better systems for protection, right? So there's always pros and
Yeah,
cons to everything.
100%. Awesome. We're at time. Thank you so much. And finally, what's next for Andre? Maybe we do a third episode at $1 billion. But yeah, what's next?
Yeah, $1 billion AUM. You guys can do a third episode. I think that's a big target. I'll try to get to 300, 400, and 500 mil first, like keeping my goals real steady. But I think what's next for OnRe is we want to first off improve the DeFi infrastructure, and that starts with liquidity. So we have been looking internally in terms of producing a RFQ system that will allow for our liquidity buffer to be more interactive for our KYC'd users who are looking to redeem, and supporting our secondary markets through there. Two, I think this is really important, is our data initiative. I think we've brought transparency towards the collateral. Now it's time to bring transparency to the overall reinsurance industry by making it more easier for people to understand the risks that we're underwriting, the types of deals that we are looking at, the historical data, etc. If we can bring that level of data and granularity, we're opening up due diligence to every single investor to become sophisticated underwriters in a way. So I think that's a very exciting opportunity. You mentioned it earlier. Third is like, I think we've really grown well here on Solana, and I'm excited by the opportunities that exist all across the blockchain ecosystem, and being able to bring OnRe, whether it's OnYC or other products, to said ecosystems, right? And being able to expand upon our thesis. So I think those are our top priorities right now, and some exciting, like I said, news before the end of this year, what we're expecting.
Awesome. That's Ayyan from OnRe, everyone. This was a fantastic episode. Thanks so much. Hope you learned something new. What is reinsurance and what is a tranche? But yeah, this is so fun. Thank you so much, Ayyan, for doing this.
I appreciate KG. Thank you guys so much. Have a good one.